Hi there, welcome to Kneppy Invest. It is Sunday, 13th of April, 2025. Current time in Brisbane is 11:26 a.m. And do you know what that means? It means it's time for another technical update video, not because of the time, but because of the day. Sunday is my typical technical update video recording day, and I think I've been doing that for the last 2 years, maybe even more than that, and nothing is going to change today. However, I envisage today's video to be a little bit shorter. I don't want to linger on indices too much. And the main reason behind that is because a lot of uncertainty is still in the system, at play, whatever you want to call it. And I think right now is no different. Sure, maybe the uncertainty has been alleviated just a bit because of the pause in tariffs. But I have been listening to podcasts, looking at or watching videos, and also reading articles, and there's a lot of different opinions out there. And those different opinions range from ultra bears to ultra bulls. So the bulls believe that we have reached the bottom, and this is just a little bit of blip in a very long bull market. Those people do exist, and the ultra bears always think we're going to drop significantly. There's no change. But the main thing was quite a few of the more respected experts think there is possible more downside to come. So you still have to remain wary in these sort of times, even though we had a really good day on Thursday, and it does look like some of the uncertainty has been alleviated. So just be aware that there is still possible mild downside to come. And on top of that, there is a chance, because of uncertainty, that we're going to see some weak economic numbers come out over the next month, 3 months, 6 months. Now, we had some good economic news during the week, unemployment numbers in America and CPI, but that was sort of backward looking before all this Trump tariff nonsense. And I do think the uncertainty in the market has increased. And when I mean market, I'm meaning among businesses and also consumers. And uncertainty really affects the purchasing decisions of both of those. Purchasing and investing decisions of businesses and the purchasing decisions of consumers. And in times of uncertainty, you're much less likely to buy that new TV, or you're much less likely to buy that new piece of technology or equipment that might help your company out in the long run. You're more focused on the short term, more less focused on the long term. So what a lot of households will be doing, well, they'll be thinking, I might not have a job in 3 months or so. So do we really need that new TV? Do we really need that 200-inch flat screen TV? Do we really need it? Or should we just hold off and just wait and see what happens over the next 3 to 6 months? So there's a lot of that happening. And because GDP is highly influenced by consumer spending, if consumers stop spending, that's going to move the economy into a recession. So that is probably the biggest fear I have right now, just because of the uncertain times we're in. And that uncertainty hasn't really changed all that much. So I do think there's further downside possible, but I want to be surprised to see the market rally from here. You just don't know. And that means I am not going full in, and also means I'm not going completely to cash. In fact, I'd probably never go completely to cash, but definitely would not be going in full in right now because of that risk of further downside, and protecting your capital is highly important to me. Okay, so let's start off with looking at the daily charts for the Australian indices. And if you have a look at the daily chart for the SGO, it's in a downtrend. And in fact, 25-day moving average has been acting as resistance for a lot of these indices, particularly in Australia. I can't remember America, but particularly for Australia. You can definitely see that with the SGO perfectly. In fact, on Thursday, the SGO actually hit the 25-day moving average and then started to fall. Now, I do expect a pretty good day on Monday. I'm not sure how good, maybe up 0.5 to 1%. But again, we're going to be affected by the American futures. So that could drive our index down or could drive it higher. And right now, the 25-day moving average is about 7,800. So still well above where we are right now. But all it takes is a 2% day for us to be right on that moving average. So SGO is being affected by that moving average. And I think we need to break it before I become a little bit more confident. And I still think it's in a downtrend. Sentiment is a little bit negative. So there is definitely more downside to come. Even if you have a look at the XAO, the 25-day moving average is acting as resistance there perfectly. In fact, it bounced perfectly off the 25-day moving average on Thursday. If we go to the small caps, is this true as well? Yep. In fact, the 25-day moving average perfectly acting as resistance. In fact, you can see the XSO sort of round over just below the 25-day moving average. It didn't quite hit it on Thursday, but definitely it's remaining below that moving average. If we go to the XTL, which is the ASX 20, another one, beautiful, beautiful, look at that. It moved higher during that little bounce in middle of March, hit the 25-day moving average and started to go down. And on Thursday, it bounced off it perfectly. Not bounced off, yeah, sort of to the below side, to the downside, yeah. So all these indices looking like the 25-day moving average is acting as resistance. What about tech? Tech had a pretty good week. It was up 4.87% or something like that. And again, it's been below the 25-day moving average for a while. And again, it bounced sort of off it again on Thursday's session. Now, I think the banking one, XPX or XPK, is the only one. We saw the banking sector rally above the 25-day moving average towards the end of March. And maybe it's the 100-day moving average that is acting as resistance for this particular indice. And that sort of makes sense because I would assume that banking, like banking companies or people investing in banking sector, CBA, ANZ, are more looking at the longer term, which means 100-day moving average is more important than 25-day moving average. So all these indices are showing that we're in a downtrend. And until we see signs the downtrend is coming to an end, we haven't got that just yet, there is possible more downside. And that is ignoring all the macroeconomic news that we might get. Now, if you have a look at the weekly chart, this was interesting. I had a look at this earlier. We have a couple of dojis in the XJO and XAO. So a doji, you can see very little body and strong shadows or tails. And the doji means indecision. Indecision, no idea, sort of like a boxing match between two equal boxers. Who's going to win? Don't know. And another way I look at this is the bears and the bulls are fighting each other and no one is winning. So beautiful, which is interesting because we thought last week was highly volatile, but in the end, the XJO was down 0.28%. So that's the doji there, fairly, broad doji. And the XAO was even a better doji. Look at that doji, beautiful doji. And in fact, the XAO was up 0.08% for the week. There you go. Who would have thought that after a very volatile week? Now, the other indices are not quite as doji looking. For example, the XSO actually had a pretty good week, up 1.83%. The XTL was actually down, which was interesting. So down 0.92%. So it seems like there might have been a rotation from the blue chips, defensive, safer companies into the more risky assets like small caps, which I find intriguing because if this was a dead cat bounce or just a bear market rally, I wouldn't have expected that to happen. So maybe the market is sort of crying out, screaming out that the bottom has been reached just because of what happened with the ASX 20 versus their small caps. Tech had a really good week, up about, was it 4.8%? Yeah, 4.89%. And the banking sector down a little bit as well. Okay, so that's the Australian indices. Interesting what's happening, but there's indications that there's more downside to possible because we're in a downtrend, that sort of thing. But if the market is right and becoming a little bit more risk on, I think that's the right word, going from the more safer defensive companies into the more riskier companies like the small caps, maybe that is the market saying, hey, the bottom has been reached. I don't know. Now onto the American indices. Now we're going to see better weeks for the American indices because their worst day was that Friday session 2 weeks ago. And they had a really good session on Monday, I think. And yeah, so I do expect much better candlesticks here, weekly candlesticks. So let's stay with the weekly candlesticks for the NASDAQ. Up 7.4% for the week. And it did sort of rebound off this little resist or support level at about 17,000. So that support level has remained strong. It's held up. And if we have a look at the other indices, you won't see much difference. They all look fairly similar. So S&P 500, yep, they had a pretty good week, up 5.7%. Dow Jones Industrial up 4.95%. And even the Russell 2000 was up a fair bit as well, but not quite as much as the other indices. In fact, this is by far the weakest of the charts. So less rotation from the less risky companies into the more risky companies. So that's the way I look at it. The bigger companies, the blue chips, would be considered less risky, the small caps more risky, and we didn't see that rotation like we saw on the ASX. So that's what I'm going to talk about when it comes to the USA indices. Now onto the international indices, and we'll stay with the weekly chart, and I expect a fair bit of volatility with all these as well, and I don't know if they're going to go up or down. The Nikkei, this is one that is interesting. So I put in this nice little support level at about 31,000. So Nikkei broke above that in May 2023, and it was a nice little support level for a while because Nikkei went sideways for about 5 months before it started to rally again. And we saw 31,000 hold firm during the yen carry trade debacle and also during the past week. So 31,000 for the Nikkei, or the Japan 2025 index, is a nice support level, and it held firm. Hang Seng had a bad week, mostly because of Monday's session. You can see it's down, even though it's a green candlestick, it was down 8.47% for the week. Whole reason behind that, Monday, down 13.22%. So just one bad day meant the whole week was down a fair bit. But overall, if you have a look at the weekly chart, sort of bounced off the 100-week moving average, but not quite as bullish as it has been. That's because of that one bad day. DAX, go back to the weekly chart. DAX, this is a really interesting candlestick. It's a solid green candlestick, which tells us the low was near the start of trading and the high was near the end of trading. So the week started off bad, but improved all during the week. So if you have a look at the daily charts or the daily, look at that. So in fact, the DAX opened at its lowest on open on Monday, and then rallied that day. Even though it was down 4%, it rallied all during that day and kept on rallying during the week. So interesting 1 week candlestick for the DAX. And the other thing is it bounced beautifully off the 100-week moving average. What about FTSE? Is the FTSE the same? No. FTSE not quite as good, not quite as bullish as the DAX. In fact, green or red candlestick, which means we did see a bit of downside during the week. So let's have a look at the daily chart. Yeah, in fact, a lot of volatility in the week. So down big on Monday, up big on Tuesday, down big on Wednesday, up big on Thursday, and up a little bit on Friday. So a lot of volatility in the FTSE. Okay, that's all I really have for the international indices. I don't think I have to look at the Canadian TSX or the New Zealand 50 index. No, we don't have to. Now on to commodities. And what I'll do is I'll have focus on the weekly chart for commodities. And I do know gold had a really good week. So gold was up 6.56%. Now, the last time gold had this good of a week, I did have a look at this, and I have a feeling it was COVID-19. Yeah, coming out of COVID-19, gold was up. The week of the 23rd of March 2020, gold was up 8.5% for that week. So that was the last time we had this good of a week for gold. Now, the one thing with gold is it's in a beautiful uptrend, but the price of gold is well above the moving averages. So on the weekly chart and also the daily chart, which would mean there is potential for a bit of a pullback. But if you have a look at the daily chart, it's not significantly above the 25-day moving average, but I wouldn't get too excited about gold right now, but it's still an uptrend, and I don't see any reason why gold can't go higher from here. But I don't expect gold to have a really good week because having 3 or 2 good weeks in a row doesn't usually happen. Now, it did happen back in when it broke out. We had about 5 good weeks in a row, but that was on a breakout. So that's not unusual. I'm trying to think. That's a daily chart. Trying to think of last time we had a really good, if you go back to July 2020, gold had 3 good weeks in a row, but when it finished that 3 good weeks in a row, it was the top of a trading range that was in place for about 3 or 4 years. Yeah, so I don't expect, and I wouldn't expect another really good week for gold. Silver had a really bad week last week, down, what was it, 16%? And I would expect a pretty good week this week, yeah. So gold down 16% last week, or silver, I mean. Silver down 16% last week, up 9.17%. And if you have a look at the daily chart, I do remember this, having a look. If you have a look at the daily chart for silver, the price of silver went from the top of the trading range on, was it Thursday? Yep, Thursday, to the bottom of the trading range on Friday. In 2 days, it went from the top to the bottom in 2 days. So down 7.7% and 8.6% in 2 days, and it has bounced. So weekly chart doesn't look that bad, but again, there is a bit of resistance at about $35. And copper, a nice little bounce as well. And copper had those 2 really bad days, but it has bounced. So copper for the week up 2.75% after dropping 14.2% last week. So a nice little bounce for copper. It almost perfectly bounced off this support level at about $4. There we go. Almost perfectly bounced off that level. Now, most of the other indices are pretty boring, I'll be honest with you. Starting off with iron ore. I think I'll go through this fairly quickly. Iron ore has no trend. If anything, it's in a downtrend. I do know there are those viewers who are fairly bearish about the long-term future of iron ore, including VBED666, because of that mine in Guinea, and I think that's a very valid reason. But otherwise, if you just have a look at the chart for iron ore, nothing to get too enthusiastic about this commodity. Same is true about uranium. No reason to get enthusiastic unless you're short uranium. And if you're short uranium, you are enthusiastic because uranium is in a long-term downtrend. Well, it depends on what you define as long-term, but definitely uranium is in a downtrend. I do know some experts who are very bullish on the long-term future of uranium, but at this point in time, look at the chart. Chart is not good for uranium if you're long. Oil, oil, I'm never enthusiastic about oil unless it's at a low point. And is $60 a low point for oil? Possibly. But again, if we do see economic downturn, oil will be affected. Demand of oil will decrease. But then supply might increase. No, supply might decrease. Now, if supply increased and demand decreased, that would be negative for oil prices. Demand, supply, yeah. The other indices, not that exciting, apart from tin. So tin looked really good about a month ago because of the closure of the mine in, was it DRC? Because of political tensions or something like that, why tin went on a bit of a run. And maybe that mine is back into production because tin price just collapsed. Or maybe it's just because of tariffs, that sort of thing. And there's one company in this space I do like. Well, I only like it because it's the only tin company I know. And that is Metals X. And, Metals X has pulled back to a support level, which is 50 cents. There you go. Got as high as 72 cents with that rally in tin, pulled back to 50 cents. Interesting. All other commodities have no interest in at this point in time because there's no trend. So we can move on to crypto. Bitcoin. Now, one of the interesting things about Bitcoin, we didn't see much volatility during the volatile times on the stock market and also bonds, I suppose. Bitcoin has held its own. And maybe not as good as gold, but it's still in a downtrend, a fairly weak downtrend at this point in time. I'd like to see Bitcoin get above 90,000 before I shift my sentiment in Bitcoin. If it went above 90,000, I'd become a little bit more bullish. But at this point in time, if anything, I'm slightly bearish. Now, when it comes to Ethereum, definitely bearish when it comes to this particular crypto. It's in a downtrend. It's in a downtrend. It's been a downtrend since start of February, so about 2 months ago. There's nothing more we can say about Ethereum, although if you have a look at weekly chart, any support levels at about 1,400? No, not quite. Or 1,600? Yeah, not quite. The really good support level for Ethereum is about 1,000. which is a round number. Yeah, the market loves round numbers. No matter if it's crypto, stock markets, commodities, people love round numbers. Okay, onto bonds. This one's probably the most interesting, I think. So we saw a massive rally in bond yields from 4.3% on Monday up to 5%. And there has been arguments. This is a reason why Trump relented, because of this rally in bonds. And I've also heard some rumors that this was planned by some certain people in the world. I've heard that the Canadian Prime Minister, what's his name again? I forget. That this was planned by him, that he set this up to offload bonds, and that would cause bond yields to rally, and that would cause Trump to relent. I don't know how true that is. It could be complete, utter fabrication. But something happened. Someone was offloading bonds, whether it was Japanese, that Japanese fund man, hedge fund, whether it was the Chinese have a lot of American bonds, or whether it was in fact the Canadian Prime Minister or the Canadians doing this. But there was something happening, and this is the reason why we had a pause on tariffs. Yeah, there you go. Anyway, so keep an eye on bond yields during the next few weeks, because what happened the last week was really interesting. In fact, bond yields rose 10.44% in the last week. Okay, and last of all, the Australian dollar rallied. Nice little rally there. Nice little rally. There's a lot of questions. Why did we see the Australian dollar collapse with these tariffs? But it has rallied back up to where it should be. And a lot of different arguments about that. The market is considering the Australian dollar to be more risky, that sort of thing. Who knows? Now, the funny thing is, if the American bond yields are rallying, then currency should be falling. Our currency should be dropping, because the American dollar is more attractive. You get better yields off the American dollar. So there should be a bit of correlation between the American yields or bond yields and the currency, but we're not really seeing that. It's just wild out there. Okay, now on to some individual companies' charts. I have about 9 or maybe 10. 1, 2, 3, 4, 5, 6, 7, 8, 9. There's a common theme among all these companies, and I think we have to go to the weekly chart to see this theme play out. And it's about value and support, long-term support. Maybe you can even say ultra long-term support, even possibly of all-time lows. So let's start off with Treasury Wines. And so this is the weekly chart going back 5 years. And in fact, what I might do is just decrease the size of my face. You're probably cheering right now. And so this is the weekly chart of Treasury Wine. I would not consider Treasury Wine to be a high-quality company at all. It needs to prove to me. However, in saying that, I do like Penfolds. Not the wine itself, but if they sort of spun off Penfolds, I'd be interested in that brand as a long-term purchase. Anyway, so back in COVID-19, share price of Treasury Wines fell to $8 and then rebounded. And then remember in 2020, there was that whole China putting tariffs or taxes on Australian wine. I can't even remember why. But that definitely happened. That's why share price of Treasury Wines fell back to $8. In both times, the share price, that was a low. Both times, that was a low in Treasury Wine. And what has happened over the last few weeks? Share price of Treasury Wines has dropped to $8. Now, in the past week, we did see the price of Treasury Wines bounce off $8 almost perfectly on Monday, but the share price is still just above it at $8.59. So price of Treasury Wines is just above a long-term support level. So if you like this company as a trade or even a long-term hold, now might be the time to take a position in this company. Now, you're going to see a similar theme as we move on to the next few companies. OFX Group. Weekly chart. Go all the way back to COVID-19. And not only COVID-19, share price fell at that point to $1. In fact, the low in the share price was 95 cents, actually 90 cents. And then back in March 2021, share price fell down to a low of $1.05. And lo and behold, what's happened in the last week? Share price of OFX Group fell on Monday to 96 cents and has rallied back up to $1.05. So a nice support level for OFX Group. So if you like this as a trade or a long-term hold, yeah, there you go. Long-term support. And don't forget, I traded this company back. In fact, I've traded this company twice in the past 4 years. The first time was on a breakout in May 2021, and the second time was another breakout in May 2024. And thankfully, I got out of OFX Group before a trend killer. On the 17th of October, share price dropped 35.75% in 1 day. But anyway, share price now $1 or just above $1. Could be support. Next company is Credit Corp. Not quite as I don't know the word here. So the other two companies, share price is at COVID-19 lows. Can't say the same thing with Credit Corp. It's not quite that low. Share price of Credit Corp fell to below $8 during that period. A lot of people have suggested to me that Credit Corp is a defensive company. They should do well during downturns in the economy. And based off what the market thinks, the market says no, that's not the case. And you can see that just with COVID-19. Share price of Credit Corp dropped significantly. And that also happened during GFC. And I think what's at play here is during downturns in the economy, people are less likely to pay back debt. You get a phone call saying you need to pay back this debt. You go, nah, sorry, I have other problems at play here. I need to pay my mortgage or something like that. So I think there's people are less likely to pay back debts during downturns, and that does negatively affect Credit Corp. And the share price of Credit Corp has fallen to $12. So it's not really COVID-19. It's the previous lows we saw back in October 2023, which was $12. And there is a possibility Credit Corp has bounced or is bouncing off that level. It looks like bounced off it on Monday. In fact, it fell to 11.50 on Monday. So Credit Corp could be an interesting level. Not my favorite sort of company. I wouldn't even consider this high quality either. I do know some people who would consider this high quality, not me. Now on to a much more riskier play, Mitchell Services. In the past, I've called this company cheap. One of the cheapest companies on the ASX, I think. Let me have a look. No, Mitch. Yeah, is Mitchell Services a buy or a value trap? This would have been a few years ago. This company, I think, always looks cheap. Not my favorite company, but I do look at whenever they release results, I do have a look at them. I had a look at their most recent results. They were not free cash flow positive. They were actually free cash flow negative. So that is a little bit of a red flag for me. So in fact, I have looked at the financial state of this company, drilling company, and you will see a bit of volatility in their financials based off how much utilization they get for their drills and their drill rigs, I think they call them. Anyway, why is Mitchell Services in this video? If you have a look at the last 5, even if you go back further, but definitely the last 5 years, during COVID-19, share price of Mitchell Services bounced off 25 cents. And we saw the share price bounce off 25 cents again in June 2022. And looks like maybe the share price could be bouncing off 25 cents again. Share price is right on 25 cents. So is this a bounce off 25 cents like we have seen in the past? Yeah, I'll leave that to you. You could also say this company is fairly cheap. If you want to have a look at dividend yield, 16%. And P/E ratio 12.44. That dividend yield, I think the market is saying right now, the dividend of this company is going to drop a fair bit. And I'll probably say, yeah, there's a good chance of that because the company is not free cash flow positive. And if a company is not free cash flow positive, it's pretty irresponsible for the company management to maintain a dividend or to even increase a dividend, particularly if there's some indications that the free cash flow will be fairly low moving forward. That's all I'm going to say, but I don't know anything about the future of this company. But yeah, not my favorite type of company, but possible that there could be some value here and it's at a support level. Oh, BHP, this one's a little bit more different. So if you do have a look at the weekly chart, COVID lows was about at $24. So BHP is well above that level. But there was a downturn in iron ore back in 2015. Share price low for BHP was at $16, or $14, sorry. And if you connect that low to COVID-19 low and keep on that line going up, share price of BHP fell below that uptrend line during the week and then bounced off it. And not only that, the share price closed right on that uptrend line perfectly, almost perfectly. So now might be a time to buy BHP, just based off that. And also, there is a bit of support at about $32, which is just above where the share price is. So that's an interesting chart for BHP, but a little bit different than the other companies in this video. Enero. Okay, this one's probably even worse. So what I was looking for was companies that are near the COVID-19 lows. I've been doing this for the last few years and just wondering if that is a good time to, a good time to buy these companies, expecting a bounce. Unfortunately for Enero, the COVID-19 lows was 80 cents and the share price fell through 80 cents on strength. So yeah, there it is, on strength on Friday, the 4th of April. Fell below, in fact, it fell below that 80 cents level the day before. They must have released something negative. I can't remember. Anyway, share price is at multi-year lows. In fact, we're talking about a decade low. Yeah, have a look at this. The last time share price was 60 cents for Enero was way back in 2014. So the question becomes, is the market overreacting to the downside? Share price was as high as 420 back in 2021. But if I remember correctly, and I could be mistaken, this company had some sort of software that was quite promising, and that's why the share price was running hard. And I think maybe that software is not quite as promising or something like that. And that's why the share price has dropped. It's also a marketing advertising company, and you would expect if we do go into a downturn, this company will be punished, will be harmed significantly. Because one of the things that companies will do when it comes to saving cash is to pay back on advertising and marketing. So that could be a bad thing for Enero Group, but share price at a decade low. Orora. Now, this company was listed. Actually, it wasn't listed. It was spun out. No, it was demerged from Amcor in 2013. If I remember correctly, so Amcor is a packaging company. Orora is a packaging company, but I think Amcor is packaging international and Orora is packaging locally. I could be wrong. Anyway, so this is Aurora's weekly chart. A beautiful chart from when they demerged through to 2018. Share price like tripled or something, but share price currently is $1.74. Last time the share price was this low was way back in 2014. So another company at a 10-year low. Is the market overreacting, or is there some legitimacy for the share price to be at a 10-year low? I had a look at the valuation, PE ratio 12.2, dividend yield 5.75%. For me, that's not attractive enough. But is the market overreacting for Orora Limited? Two more companies to go. Amotiv released a negative trading update a week ago. I think it was on Friday. And the share price plunged to about $7. And look at $7. So $7 was support during COVID-19, also support in October 2022, and maybe it's support now. So maybe now is the time to buy some Amotiv shares at about $7 or just above $7. So another company where it looks like there is support at $7. But if you have a look at the weekly chart for this company, yeah, no interest in this long term. Just a possible bounce of $7. And finally, CSL. And look at that. CSL. In fact, originally I did put this little support level a little bit higher. But then I went, let's put it at this level, which was the lows of CSL back in late 2023. So $230, and share price of CSL is $233. I've been thinking about this the last few days. I've been thinking of adding to my CSL position. I do think the market might be overreacting, P/E ratio now below 30, which is fairly rare for CSL, 28.23. If you don't believe me, let's have a look at the P/E ratio for CSL. Now, I do know there's concerns about tariffs on pharmaceutical companies, that sort of thing. But if you have a look at the P/E ratio for, according to this, the P/E ratio is 26.5. So FinChat is even lower. And if you have a look at the P/E ratio history of CSL, whenever the P/E ratio falls below, in fact, I haven't looked at this, so I'm just, that's wrong. What the hell is that? P/E ratio is not 13. That's wrong. So according to this, the P/E ratio is 13. FinChat has made a little bit of an error here. It's probably got the wrong company or something. Because if you go back to, let's go back to, what was it? The summary, the overview. We know it's a mistake because in their overview, they have a P/E ratio of 26.5, but that says it's 13. So there is something going on there. Is it half of this? I have no idea what FinChat is doing. But definitely P/E ratio of 26.5 is fairly low for CSL, historically low. So now could be a good time to buy some shares or add to your position in CSL. And the other thing is, whenever it gets this low and whenever it gets below 250 is a good time to buy, and the share price usually bounces. Usually. Maybe now is different. Okay, that's all I have for today's video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.